we're going to learn about investing more today. So we went through it a bit in other classes, but we'll go farther into this today. So since we got through all the chapters, chapter 12 to 15 for the course, we're gonna focus on investing for this class, and then the next class will be a review class. And the class after that, there won't be a lecture, it will just be the final exam. So I'll give you time to do the final exam, and then it'll be available over email and WhatsApp to for questions. Morning, Brooke. So yeah, the next class will be review, and the class after that will be the final exam, where I'll give you time to do the final exam, and then I'll be available over email and WhatsApp for questions. But yeah, so today we'll be focused on applying what we've learned to investing. So questions to be answered are what is value in growth investing? So we're going to answer that question. And then we're going to also answer what are the key differences between value and growth investing in terms of risk, return, investment objectives, and time horizon. And then what are the key metrics to keep track of as a value investor and as a growth investor? And what are some examples of value and growth stocks? So we're gonna focus on that today. Some examples of value and growth stocks. So also we'll go through how we can use the screening and portfolio analytics tools on S&P Capital IQ if you're either a value investor or a growth investor. So what is value and growth investing doing in the Asia Pacific region also? So that's what we're going to go through. I also posted this in part 2. It's value investing Prezi. So if you want to go through it, and also will be recorded on the YouTube channel that I posted on the part 2 page on the course. So value versus growth investing. So value investing was developed in 1934 by Benjamin Graham and David Dodd. Stocks trading less than their intrinsic value you buy. It's a long-term strategy. So Warren Buffett, he says, I never attempt to make money in the stock market. I buy on the assumption that they could close the market the next day and not reopen it for 5 years. Warren Buffett. So that's his strategy. So investing for the long term, don't buy and sell quickly, short term. And then growth investing is also known as capital growth or capital appreciation strategy, focusing on increasing capital, and earnings are expected to increase at above average. So even the amateur investor who lacks training and time to devote to managing his investments can be reasonably successful by selecting the best managed companies in fertile fields of growth, buying their shares and retaining them until it becomes obvious that they no longer meet the definition of growth stock. That's Thomas Rowe Price Jr. So key difference between value and growth investing are risk and return. So value investing is lower risk. It offers capital growth and pays dividends. It's less volatile. Growth investing is higher risk and more probability of loss, higher earnings, and more volatile. Investment objectives. Value maximizes returns through finding stocks that are undervalued by the market. So you're finding undervalued stocks in value investing. Growth investing, you seek capital appreciation through growth securities, which offer low yields, but considerable opportunity for an increase in value. So time horizon long-term, value stocks tend to outperform in bear markets and economic recessions, while growth stocks tend to excel during bull markets or periods of economic expansion. So in that case, growth stocks are better in great economic times. And then value stocks are better in recessions. Yeah, so that's key here. And then some key metrics that you got to look at for investing in value stocks and growth stocks. I'll go through those here. So value key metrics are price to earnings ratio, price to book ratio, debt/equity ratio, and free cash flow. So in this case, these are the key metrics for value investing. So you want P/E ratio that is like 10 times for mature companies. Yeah. So like and then the lower P/E ratio, the better. But sometimes the P/E ratio is high because the growth is high. And it could potentially be a good investment. Still. Yeah. So yeah, usually it's usually the P/E ratio is the same as the growth in earnings per year. Usually. So let's say 40, you have a 40 P/E ratio. That probably means that the earnings should be growing at 40% per year to allow this P/E ratio to be high, to be 40. And then also 10 P/E ratio, earnings should be growing at 10% per year. So that's really how that works. And then the P/B ratio is price to book ratio. So it shows the price compared to the net assets. So like the lower, the better, but not too low because the company may have debt problems. So like a 1 P/B ratio is good because the company is priced at the net asset value. And then the debt to equity ratio, you want to have a debt to equity ratio of 0.3 to 0.5 because that means that the company is not taking on too much debt compared to their equity. So that's important here. Also, the free cash flow should be increasing every year by a large margin. So this is the amount of cash the company generates. So those are very important metrics you got to look at when you're investing. So I recommend looking at those. So price to earnings ratio, P/E ratio, shows what the market is willing to pay today for a stock based on its past or future earnings. High P/E ratio is overvalued. Low P/E ratio is undervalued here. And then price to book P/B ratio shows what investors are willing to pay for each dollar of a company's net value. The P/B ratio is more useful the greater the number differs from 1. So if the P/B ratio is high, like 10, that can be a problem. Because the company is priced at 10 times its assets. So there is a lot of room to fall in the price. So that becomes an issue that could be a big risk there. So you got to watch out for that. And then debt to equity ratio shows the proposition of equity to debt a company is using to finance its assets. Low debt D/E debt to equity ratio. The company uses a lower amount of debt for financing versus equity. High D/E, that means the company derives more of its financing from debt relative to equity. So yeah, this is an important metric to look at here. And then free cash flow, FCF, the cash left over after company pays for its operating expenses and capital expenditures. It can be an early indicator to value investors that earnings may increase in the future, since increasing free cash flow typically precedes increased earnings. So that's a good metric to look at too. Key metrics growth investing are historical earnings growth, forward earnings growth, return on equity, and net profit margin. So we'll go through a lot of these here. So some of these are very important, specifically return on equity. So historical EPS growth, if the company has displayed good growth in the recent past, it's likely to continue doing so moving forward. The percentage change in normalized earnings per share over the previous 12-month period to latest year end here. So that's a good one, showing, like we said before, if a company is having a P/E ratio of, let's say, 40, their historical EPS growth should be 40% per year to justify the price. So that's what you'd have to look at here. And then forward EPS growth investors pay close attention to this as they try to determine which companies are likely to grow at above average rates compared to the industry. So this is prediction. So you like we said before, if forward EPS should be 40% if the P/E is 40. So it should equal the P/E too. So in this case, the historical EPS growth should equal forward EPS growth and also equal P/E ratio. So they should, all three measures should be similar. Yeah. And then return on equity, it provides investors with insight into how efficiently a company is handling the money that shareholders have contributed to it. So return on equity equals shareholder equity divided by net income. So you want a return on equity. You want a return on equity higher than 20%. I would recommend 30% or more. Usually, but 20% or more is good. So like find stocks with this amount, this percentage of 20% or more. So return on equity is one of the most important stats on a company investment. And the net profit margin illustrates how much of each dollar in revenue collected by the company translates to profit. Net profit margin is net income divided by revenue times 100. This is not as important, but net profit margin above 20% is good. So, but that's good. But the return on equity is more important. So return on equity, and cash flow, free cash flow, are the two most important stats to look at when you're investing. Yeah. So examples, so sample companies. So value company example, iHeartMedia Inc. Their price to earnings ratio is 0.245 here, and their free cash flow is 800.6. So that would be a potential example in this case. So let's put this in the chat here. So radio is a good, yeah, so this is a potential example here for a value company. But I'd recommend I'd recommend after class today, analyze iHeartMedia using the tools from this lecture and let me know what you find, and let me know if you think it is a good investment. So that's what I want you to do after the lecture. So then growth company example, Netflix Inc. ranks 5 on Fortune 100's fastest growing companies. Revenue 3-year annual rate is 33%, beat S&P 500 3-year return. EPS 3-year annual growth rate is 129%. So that's an example of a growth company here. So, and then same for Netflix. I'll look at Netflix and let me know if you think it is a good investment. Looking at their free cash flow, return on equity, and other stats. Yeah. So then screening. So screening for value, you have to look at the exchanges, the earnings per share. So like based on this, I'll put this in the chat here. So as they say here, you're looking at which exchange it's from here. Just put this in the chat here. So determine which exchange it is from. Determine if the price to P/E ratio is less than 10. Determine if the price P/B value is less than or equal to 1. And also determine if the market capitalization is greater than 500. Also, total debt to equity should be between 0.3 and 0.5. Levered free cash flow should be increasing per year and positive. So those are different things you got to look at here. So those are potential ways to screen. And then for growth stocks, you would look at, let's say, consumer discretionary, industrials, materials, real estate, and energy. So you're looking at, so for growth stocks, look at return on equity, earnings per share. Yeah. And then ranking. So P/E ratio, these are some examples here. I'll just skip this because skip this right here. I'd recommend, look at if these companies, these are just examples. Don't invest in these, but these are just examples from this this PowerPoint. Don't invest in those. So screening growth. So criteria, growth. So you're looking at exchange, EPS growth, return on equity, net income margin, and a dividends percentage. So a dividend percentage of 5% or above is high. So a dividend is the interest you earn from a stock. Yeah. So then portfolio analytics. It's good to have a diversified portfolio. So the number one key to investing, number one key to investing is diversification. So like own companies from industrials, real estate, consumer discretionary, materials, and energy. Energy, financials, information technology, communication services, consumer staples, healthcare, utilities, and energy. So yeah, own different industries and different investments from different countries. So that's key. That's key for investing. So you got to make sure that you do that here. So I'll put this in. This is a good balance that they have here. So they have, as you can see here, they have in the right one, they have 22% in financials here, 16.83% in consumer discretionary, 16.38% in information technology, 11.9% in communication services, and the rest. So it's a good balance they have. So that's a good balance potential for your portfolio. And also this one over here is a good balance too. But so like the one on the right is the better balance of diversification because you own more industries. Yeah. So country weights, this is a good balance too because you want to diversify across countries here. So this is a good balance here. So here, this one's pretty good. This one here, this is a good balance. But the one on the right is a better balance. It's good you're diversified here. So it's a good balance. I would recommend investing most in Canada and the US. So like maybe at least 50%. And then investing in all of these other areas for the other 50% using exchange traded funds to invest in China, Taiwan, India, Hong Kong, Thailand, Malaysia, Indonesia, Philippines, Pakistan, Singapore. Yeah. So yeah, do that. So yeah, this is a good mix too here. So I'll put this in the chat too. So yeah, good mix again here, good mix between a lot of different industries. And like I said, this is available under value investing in part 2. So you can check this Prezi and I'll also post this recording so you can watch it if you wish. So this is a great distribution across countries. So